Yeah, I don't think I'll be able to.
Okay. Can everyone see that?
Yes.
Okay, yeah, so we've got a pretty quick high level, probably a recap for most of the presentation on business valuation, mostly like the market approach and multiples. So my name's Tim. I started working in valuation 10 years ago. Majority of that has been for acquisitions through SBA financing with some gift and estate and litigation work sprinkled in there. And about half a year ago, joined Cameron's firm, Value Buddy. So I'll let him introduce himself.
Yep. Hi, everyone. I'm Cameron. My background is in private equity due diligence initially. So looking at larger deals, typically $100 million plus. And about 4 years ago, I co-founded Value Buddy, which is an SBA business valuation firm, where about 80% of our business is for SBA lenders. 20% would be business buyers or sellers. Um, but yeah, we work with a lot of the top SBA lenders like First Internet Bank, Huntington National Bank, et cetera.
Right. So an interesting data point. Q3 of 2024, uh, middle market acquisitions in terms of purchase prices in regards to EBITDA multiples were about over two times higher than those for small businesses. The trade-off there is obviously having to manage more entities, more businesses. So let's say you had to looking at buying a company with 3 million in EBITDA versus let's say six individual businesses with 500K. The EBITDA there is the same, but managing multiple businesses, obviously, it's one thing if they're all the same type of business, but if they're different demographics, different risk factors, different types of internal processes, it's a good amount more work to manage, five or six businesses compared to one. But for that much of a discount, I'd say it's worth it, and investors seem to agree. And for smaller businesses, the emphasis is on SDE or seller's discretionary earnings. That's basically your EBITDA plus the owner's salary. And if there's any personal expenses or anything like that, non-related to the business, also added back to that. And the reason for focusing on SDE as opposed to EBITDA, most of the time we do a blend uh, with a majority of the weight within the market approach on EBITDA. But for a smaller business, the there's a higher portion of the owner's benefit is their salary. So let's say you have 300K in EBITDA with 100K salary. That's going to be a 400K SDE. And a quarter of that, 25%, is the owner's salary. As you get bigger, a 100K salary is a smaller and smaller portion of EBITDA or whatever earnings metric you're looking at. So for smaller businesses, SDE kind of gives you the closest look at what an owner is taking home at the end of the day. So that's basically the owner's benefit pre-tax. And it's also one of the main metrics that banks look at when doing an SBA loan. They mostly look at cash flow to cover debt, but a close second, I'd say, is SDE. And if they're doing a rule of thumb, they probably look at an SDE multiple. So, kind of along that point, as earnings grow, so do the multiples. It's not like set in stone. There's other factors. If we're doing an actual valuation, we look at the industry primarily. We look at earnings levels, uh, revenue levels, but the trend in general would be for larger businesses that the multiples get higher very gradually. Um, like though you could see, depending on the industry, you could see it, a business with 250K SD or lower at a 3x. But overall, you pay a higher multiple for a more stable and less risky business, basically. So here's some data on multiples by industry. Um, I think of it as kind of things that are easier to run, get a higher SDE multiple. Let's say a liquor store. It's pretty much plug and play. It's a little harder to mess up. The products are pre-manufactured. Everyone's familiar with them. Usually pretty consistent revenue. With some, if you have some business management experience or some good training, it's a pretty safe investment. So things like that get a higher multiple. Whereas, let's say restaurants a little bit lower, they're harder to run relative to how much you make. You're making the product every day. It's very customer facing. Uh, Maybe a lot of owner goodwill. A change in ownership could impact the performance. And then even more so, let's say like a dentist. There's a ton of professional goodwill. You've got to be a dentist to buy a dentist's office if you're going to be running it. And then I will let Cameron take it from here for kind of where you switch from SD to EBITDA, and then some changes in the SOP.
Yep. Thanks, Tim. As Tim mentioned, most of the small business deals, or like very small businesses, depending on how you look at it, are valued based on sellers' discretionary earnings for the market approach. But as you get larger, as Tim mentioned, less of the owner's benefit is derived from their salary. And so there's no kind of set in stone point where this transition takes place, but you'll typically see it take place around 5 million in revenue or 2 million in earnings or profit. So like with that $100,000 example, with 2 million in profit, you're looking at only about 5% of your owner's benefits being derived from the salary. So in a situation like that, that's where EBITDA begins to become a bit more appropriate to use in the market approach. Typically, SDE is preferred for owner operators that are stepping into the day-to-day operations. When you get into like 2 million in earnings or about 5 million in revenue, typically the owner is a little bit less important in the day-to-day operations, or they operate in more of like an executive role. They're not like a dentist running the office, the dental office, day to day. And for larger businesses, EBITDA becomes more relevant when owners are less involved in the operations. So yeah, especially if you start getting into private equity size deals with 100 million in earnings, the owner is one of maybe a few hundred employees. So at that point, their salary is pretty irrelevant to the earnings. And then next we have looking at why larger businesses command higher multiples. So as Tim mentioned, part of it is just things that are easier to run or less risky to run. So it really boils down to that. Bigger businesses are less risky. They typically will have a lot more customers, less customer concentration. If you have a 5 million revenue business, typically that's not all coming from one or two customers. You likely have a larger book of customers, and that's less risky, especially with the change of ownership. If you have one or two key customers, those could be strongly tied to the owner, and they may not transfer over to a new owner. Another factor would be cash flow. Typically, larger businesses are a bit easier to project. They have pretty stable historical growth rates. They're not varying, vastly year to year. They're not growing at 30% year over year. All of that is kind of favorable to driving a higher valuation multiple. They also have deeper teams. It's not just only the owner running the business. You might have an experienced executive team or an experienced manager helping to run that business, which also lowers the transition risk. And then also documented processes. That's a huge one. You'll hear a lot of jokes in very small businesses that you might get handed like a napkin with the processes written on it, or like passwords to some of the accounts, things like that. Larger businesses have typically outgrown that. And so they have processes that are easier for someone to pick up and run, the day they take over the business. And in those very small deals, and I guess all deals, but especially the very small businesses, there's something called a J curve. It's not, the same for every business, but often in the first year of a new owner running the business, they'll see a bit of a downturn in profitability before it eventually picks back up and exceeds where they took the business over. So things like documented processes can help flatten that J curve so that there's not as big of a loss in year one. Yep. And here is kind of a summary of the SBA SOP changes that go live in a few days. I know we were talking about some very, hot off the press ones at the beginning of the call. This is more of a summary of the overall changes. So the first one is stricter equity injection rules. Seller financing categorized as standby notes now faces significant limitations under the new guidelines. Um, partial ownership partial changes of ownership are now restricted. Asset only sales are prohibited with mandatory 2-year guarantees from all. So all sellers there would have to make a personal guarantee. Enhanced underwriting standards. There's less what was called do what you do. So the prior version of the SOP essentially told SBA lenders to follow their typical processes that they would for issuing similar sized loans. But now they're cracking down a little bit on having specific underwriting standards for SBA loans, since especially with like tech-enabled banks, they didn't always have as robust of underwriting processes, and so that caused or is believed to have led to some higher default rates. And then the effective date for this, it goes live June 1st, so yeah, a few days from now. If you're working with a preferred lender, they have to pull that preferred lender number before June 1st. So essentially, if you don't have a deal that's already in underwriting with an SBA lender, you'll be taking out SBA funds under this new SOP. I think that's all for the new SOP there. And then here's just a few general tips we pulled together based on our experience. They're not necessarily business valuation related, but they're things that we've seen have typically made for more successful changes of ownership. The first one is to work with specialists. It's not always the best practice to work with like your local community bank, even if they do offer SBA loans. You ideally want to work with a bank that does a ton of business acquisitions. So, I mean, we could provide a list of those, some of the ones we work with, but SBA lenders like Live Oak Bank, First Internet Bank, et cetera, they're very focused on business acquisition loans. And so if you're working with like a BDO at those banks, they're going to be a lot more well-versed in the process. Especially with the new SOP coming out, you'll really want to be working with specialists there. The next is to invest in quality of earnings, especially for some of those larger deals. This is probably one of the most valuable things that you can invest in during the deal, besides working with an SBA lender that's specialized in acquisitions. And then the last one is ensure that there's sufficient working capital. We see a lot of SBA loans that are, I guess, undercapitalized from a working capital standpoint. And that's really important with that J curve that I mentioned earlier. Your projections aren't always going to be, or like actual performance won't always line up with your projections, especially in that first year or so. So it's extra important there that you have sufficient working capital to come out on the other side of that J curve. Yep, and I think that was it for our presentation. I know we kept it pretty high level there, but definitely open to the Q&A if anyone's looking to dive deeper into any of these topics that we covered today.
Perfect. No, first off, thank you for the presentation. It was great and helpful because I think there are still a lot of confusion when it comes to the valuations, especially with brokers who kind of sometimes just do different things to get to a valuation. So I'll just kind of start us off with a Q&A. First, do you guys at Value Buddies usually work with sellers or the buyers themselves, or is it kind of mixed?
So typically we're working with SBA lenders, so it would be on the buy side of the deal. But the report is engaged by the SBA lender as part of their underwriting.
And so that means does the buyer just pay for, or is the SBA suggesting they use you, or is the SBA the one paying you, or the lenders?
So we're paid by the lender, but typically the buyer is paying the lender for the services, or it could be rolled into the cost of the loan. It's an SOP requirement for deals over 250,000 that the lender purchases a third-party business valuation. And so you have to meet certain criteria to qualify under the SBA to be a provider there. But every bank has different providers that they work with.
Interesting. I can ask several more, but Will, Chris, Ganyu, or Naveen, or anyone else want to go and ask a question or two?
No, I think great presentation. I'm always interested in hearing about valuations because we always hear all the crazy stuff, the wild, wild west. So I think kudos to y'all actually having that kind of information. So right now, I don't have any questions. I appreciate y'all giving this presentation.
I guess
Appreciate
another
that.
time. Oh, sorry, repeat that.
No, I was just saying I appreciate that. And if you have a question in the future, feel free to reach out if you think of something.
And then, okay, then I'll kind of lead next. Is like, you kind of mentioned these multiples at the start, and we've all kind of seen them before. With the 250, if I can't remember what you said had, but like from 0 to 250, it was, yeah, two multiple. And obviously, it kind of varies from industry to industry. But with that multiple, like Chris here, she kind of helps businesses prepare to sell, kind of removing the owner little by little. And Chris, if I say anything wrong, please let me know. But with Chris' service of kind of helping remove that owner, if the owner is very semi-absentee to maybe 10 to 20 hours a week, does that really change the multiples you use, or does it stay pretty standard within that range?
So yeah, that's a great question. So most of the market multiple data that we pull from assumes a full-time working owner. So in the case of an absentee owner or a part-time, what we do is get the kind of next person in charge. Whether if it's an absentee owner, we'll just get the general manager's salary, and we could use that as an add back under the assumption that a hypothetical buyer could come in, just get rid of the manager and assume that role, and therefore that then becomes part of a full-time working owner's uh, benefit.
Okay, that makes a lot more sense. And I haven't heard it approached that way. And so it seems like with these valuations, they're a little bit. I know you both have worked in larger deals, private equity, Cameron, you had mentioned. So it seems like they're a little bit, you're not using a discounted cash flow or anything fancy like that when it comes to these.
We do. Uh, Typically, it's 50% market approach with the multiples here, but we also do an income approach with a DCF. A lot of times, it's just a steady growth rate, unless it's like a growing business. But we do an income approach with projected out 10 years, followed by like a terminal value, and then build up a risk rate and all that. Yeah. So yeah, we do the two approaches.
Okay. And then again, if anyone has questions, I just want to help us facilitate a lot of information for this. So if you have questions, please just ask away. Um, Chris, you unmuted yourself.
I did. I'm still getting over the shock of like doing the opposite of what I do and everyone else I know does as far as like add backs and chargebacks and owner's salary. I did have a question about and I apologize, I'm looking to my notes on the side when it went through the changes. You had mentioned the assets only sales. It has a 2-year old owner or new owner PG. All sellers from the sellers. So did I understand that correctly? When it sells, the exiting owner is required to provide a 2-year guarantee still? Am I reading that wrong? Number
Yes.
two?
My understanding is in an asset-only sale, the new SOP requires all individuals acquiring ownership, regardless of their percent equity, and they must be co-borrowers and provide a full personal guarantee.
So that's for the buyers, not the sellers.
Yeah, it would be all anyone acquiring ownership, so
Okay.
buyers.
Okay. That makes more sense. I thought that was interesting. So I just wanted to make sure that wasn't, because I know there's like a lot of interesting changes, and I don't usually use SBA or look at SBA. So it's helpful to understand whenever I can, since I'm not familiar with it. Thank you.
I think what you're talking about there, Chris, is the partial change of ownership thing. So if you do the rollover equity thing, so in that case, they are requiring the sellers to put in a PG. So that's the part of the new SOP basically. So that's why these partial change of ownerships are just not going through anymore.
Because the one selling doesn't want to do that,
Yeah,
even if there's
exactly
still
right.
a
They don't want to
partial
go PG. Right. Yeah.
Just summarize, it's kind of they basically eliminated the rollover equities you could do. It's hard to do that with the new guidelines for sellers, having them keep any ownership.
Okay.
Yeah. Okay.
I had a question, Tim or Cameron. Could you guys give us some context around like how many of these evaluations you guys do and what size do they typically fall under?
Sure. Cameron, do you want to provide our kind of recent numbers?
Yeah, I think we average maybe 2 to 3 per day. Um, so about 50 per month. And as far as size, they vary. So the minimum would be about 250,000, since anything under that doesn't require a full business valuation. I would say average maybe a $1 million purchase price, and then maximum 5 to 10 million, because most of them are for SBA loans where the maximum's 5 million, but we do receive some higher than that with like a mix of conventional lending as well.
Okay, got it. Yeah, that's great to know. So that's quite a bit, right? 50 per month is quite a lot. So you guys have essentially you're not doing this manually, right? You're using a software to pull the data, and your tech does the valuations. Is that correct? Based on both DCF and market comparative valuations. Is that correct?
So we've built some proprietary technology to help us with pulling like comp data, for instance, but all of the actual analysis is done in-house by Tim and our valuation team.
Okay, got it.
I have kind of a question that follows that as far as statistics goes. With like in general, more than 80% of businesses now that are listed don't end up selling for about three main reasons. For the ones that actually get to your desk, like what's the percentage if they make it to this point and they are looking for SBA lending? What percentage of businesses are you seeing right now that are closing versus not closing?
Yeah, we come in a bit later in the SBA lending process, so generally they at least have like initial pre-approval if they're going to purchase a business valuation. So I mean, over 90% of loans that we see close, but that's because we're coming in at like the back half of the underwriting process.
Okay.
Yeah, I was going to say maybe 1 out of 10 come in below value. And then that's an obstacle for getting the loan approved and obviously closing. But yeah, if 1 out of 10 seems right, that most of the time the bank's done their underwriting and then we kind of confirm.
Okay. So there's a lot that happens before it ever gets to you guys as well, as far as valuing goes and underwriting.
Yeah, and especially if it's an SBA lender that does a lot of business acquisitions, like bad deals are getting screened out way before they even get to underwriting. Which most of the SBA lenders we work with are primarily focused on business acquisitions.
Okay. All right, cool. Thank you.
And are there any specific things that bring down the valuations? For example, I was looking at a business which has very fluctuating cash flows. So, for example, they're seasonal, so they make a lot of money in December, and 5 months out of the year they're actually running in red. So things like that, as a buyer, I would offer, and I did offer them a lower price because of that. But do you guys take that into account? And are there any other factors like that?
I'd say if annual revenues are fluctuating a lot, then that creates risk. But if it's seasonal within the year, but from year to year, it's consistent. Let's say like an ice cream shop, they're not going to do much during the winter, but they do a lot during the summer, and that happens year over year. So the seasonality in itself, as long as it's consistent from year to year, wouldn't hit it with any sort of increased risk or anything. Declining sales or declining earnings is definitely the big thing. Or if it's projection based, that increases the company specific risk. Or if let's say there's been stable earnings, but they're about to add a new section of the store or expand it all, and the buyer's buying it based on that increased capacity, that'll kind of add some risk.
Yeah, I think other ones too would be like customer concentration is important for the small businesses. And even like size of a small business, like a $250,000 business is a lot riskier than a $3 million small business. And both of those are considered small businesses. And then we have a pretty detailed risk assessment that we include. So, I mean, we're even looking at things like tariff risks for different industries, but that's a pretty small factor in the overall discount rate. Yeah, there's a number of other factors like key relationships that the owner has. That's another risk that we look at. If they're like, if their cousin is making up 25% of revenue with like their business purchasing from the owner, that's obviously a huge risk. That's an extreme example, but definitely a risk it's pretty material in these small businesses.
Got it. Yeah, that helps. So you're essentially doing a qualitative risk analysis and kind of risk adjusting the price based on all of these. It's just your team does it manually.
Yeah, so that's primarily in the income approach. So as we mentioned, we'll prepare a DCF model, and part of that is obviously the discount rate. And so all of those factors go into building up what that final discount rate is.
Okay, got it. Yeah, that's great. No, thank you.
No, great questions, everyone. And actually, I kind of want to follow up on that a little bit. With what you're doing with these valuations, like I look at a lot of franchises, and sometimes the brokers will want to factor in the asset or, yeah, the inventory or assets we're trying to buy up with it. Do you guys ever factor those into the valuation too, inventory or assets of the company itself?
Yeah, so for the income approach, most of the time we look at the company's historical working capital to determine like a benchmark of the amount of working capital you need to maintain operations. And then the inventory obviously factors into the working capital. So if inventory is transferring and that's a majority of the working capital and that hits your benchmark, then there's no adjustment to the income approach. If there's like a ton of extra inventory, we might add anything past the benchmark to the income approach.
Mhm.
Or if there's cash transferring, that kind of has the same effect. Within the market multiples, they're on the basis that only fixed assets and inventory, if applicable, are transferring. So anything outside of fixed assets and inventory would get added on top of the market approach calculations.
Oh,
And if there's not enough inventory, that would be a deduction.
no, it's very interesting. I won't lie, from at least my perspective, to hear from the actual valuation experts versus like the brokers who, at least from what I've seen, have been the most popular method I've used is use like a weighted average of the past 3 years SDE, and then they'll just find the highest multiple standard for that industry and just use that. It's interesting.
Sometimes that works. Like sometimes the rule of thumb like gets you pretty much to where a more detailed analysis would, but then you have the times where you kind of miss something big and it, has a big impact.
No, most of the deals that have fallen through for me is when they tried to use a rule of thumb for some things that just shouldn't be applied in the cases. And I'm just like,
Gotcha.
we could put 30% down here and it would still lose 10,000 a month. I've had a deal like that come across my desk twice. Um, but no, okay. Um, I,
Can I ask a follow-up on that, Jackson?
please.
So about inventory, same thing, right? About assets like inventory, FFE, and things like that. You don't add them back, right? So, for example, if you've got $1 million EBITDA business, and just based on comps and things like that, you come up with $4 million valuation. The FFE that's in it, any inventory that's currently in the business, and maybe a little working capital, that's all just part of it, right? You don't get to add those back because you're essentially combining like a asset approach and a market approach. You're kind of conflating them, or you're mixing them up, right? Is that correct?
So yeah, within the market approach, inventory would not get added, since to kind of keep everything consistent, that the primary database we use provides multiples on the basis that only fixed assets and inventory are in the deals. So if it's an inventory-based business, kind of inventory is coming in and out constantly, and it's kind of required to generate the cash flows that you're applying a multiple to. But anything outside of inventory, let's say cash, AR, or any liabilities, would get added or subtracted to, you said a million times four, the 4 million. So if there's cash, gets added to that 4 million, or any other assets outside of inventory would get added, and any debt or just short-term liabilities would get subtracted.
Got it. So like real estate, if they had real estate, that would get added. Is that right?
Yes. So if the company owns the real estate, typically, well, it depends how the deal is structured for us. If it's a combined purchase of the business and real estate, we would just straight up just add the real estate on top of the calculation of the business's value. A lot of times the bank just wants to value the business, in which case we just remove the real estate.
Okay, got it.
That is interesting. I thought the banks would want them to buy the real estate with the business to
Yeah,
help.
that's what I was going to ask about
That
the real
Oh
estate.
yeah, that's pretty common. Sometimes, like if it's two separate purchase agreements, they will get a real estate appraisal and then a business valuation separately, and then they just take those and combine them on their end. And if they want us to include the real estate, they'll give us the real estate appraisal, and then we'll take that real estate appraisal value, put it onto the balance sheet, and give them a combined value.
Hey Tim, so in a situation like that, and so this is interesting. So being so with the SBA, because because I've over the period of time I've tried to do a couple. I haven't yet. Um, tried to do a couple of deals that actually had the real estate, which would actually take it from a 10-year business deal to a 25-year real estate transaction. Um, would that actually change the valuation? Like, how would that change the valuation? If you can explain that, I'm curious now, or not to
So,
complicate. Then you can say, no, this is for another class.
um, so a business, it wouldn't it would not impact the business valuation
Okay.
because you kind of look at the business as a standalone asset. Even if the company owns the real estate and they're not paying rent, to get the actual value of the business, you got to put in a fair market rent expense.
Hmm.
Even if the real estate's transferring and they're not going to have a rent, in order to get the value of the business for a hypothetical buyer of just the business, you got to include a fair market rent. So regardless of what's happening with the real estate or the length of the loan, how you value the business stays the same.
Got it. Because they still need a place to run the business. So it's not, got it. Got it. That makes sense. Gotcha.
Yeah.
Appreciate that.
Um, uh, go ahead.
Yeah, have you guys ever seen an SBA purchaser use a sale leaseback type transaction? So where they would do a sale leaseback on the real estate and use that cash to buy the business. Have you guys ever seen something like that? I think the SBA sees that as circular funding, so I think they don't allow it, but I'm just curious.
I can't recall ever seeing that. Um,
Uh,
yeah, I feel like they probably wouldn't allow that. That's an interesting
Right.
question.
Okay.
Remind me, Naveen, and I know a guy who's seen it work with one deal or two, for bigger deals, but if you remind me through email or message, I can introduce you to a guy who does sale leasebacks.
Yeah, no, I do know a few people, and I've asked them this about SBA, and they haven't. They said they'll look it up, but they haven't come back about it. But yeah, you're right. In general, for straight commercial loans, it's more common.
Okay.
Like there's a guy on Acquiring Minds podcast that did I think a $15 million deal or something, and essentially turned out to be zero out of pocket because he used sale leaseback, and yeah, it was a great deal. But I haven't seen that in SBA world for sure.
No, but great questions again from everybody. I only have one more, I guess, and this just goes to my more niche. With franchises, I guess, do you guys, when you get those type of deals, are they because it's a part of a brand, do you use the same kind of similar multiples, or is there anything different about them?
Yeah, good question. Yeah, I'm a fan of giving a premium to the multiple for franchises.
Yep.
Maybe increase it by a decile or two, or maybe even to the 75th percentile, depending on the brand,
Mhm.
rather than the median. Yeah, just they basically come with a manual. Definitely less risky, um, easier to sell. Um, uh, yeah, for those reasons, basically. I would.
Okay.
That's interesting that you say that, Tim, because in general, franchise valuations of multiples are actually lower, right? When they're being listed, they're lower than regular businesses, aren't they?
I've seen them as higher. I see like Dunkin' Donuts going for like 3.5 times SDE or more.
Yeah.
Um,
Oh, for sure. I mean, things like that. If I guess if you're buying a McDonald's or a big franchise like that, yeah, for sure. But I'm talking about like smaller ones, right, where you do, um,
The emerging
I don't
brand.
know. Yeah, yeah, more emerging, like print shops, like Minuteman franchises or things like that. Their valuations are lower, but it could be just that they're overall SDE is lower. It could be a factor of that. So I'll have to look back into that.
Yeah, in terms of multiples, I mean, I'd be curious to see. I feel like overall I've seen them sell for higher. But yeah, I guess
I see.
if it's a newer brand, there's almost just as much risk as just being an independent business. I wonder if I could use the database we referenced to just pull franchises. I wonder how granular that could get. But um, I mean, you might not be wrong. Like we must be right. We both might be right in some cases. But I'd say for the ones I've seen, they typically get for a little bit higher.
And
Okay.
I think that's been more of my experience too. It was just curious, interesting to hear how y'all approach it. It's similar to my mindset. They're less risk and the procedures are there and the brand's there. Um, I guess one other thing I'll ask, and then we'll have time for maybe two more questions with is you mentioned the J curve. And so you've seen it like when a person buys the business during the transfer, sales dip a little bit, then slowly make their way back up, or can you kind of elaborate more on that J curve?
Yeah, that's just kind of a general business acquisition trend. It obviously varies business to business. We're not when we model out cash flows for like a DCF, we're not trying to predict the J curve takes 6 months or 18 months to rebound. Because as Tim mentioned, we're projecting the business's cash flows out 10 years. So yeah, it's not like granular to the point that we're trying to like predict how steep that J curve is. We're really looking at more of like the sustainable growth rate over that 10-year period.
Okay, okay, that makes a lot more sense. Interesting. No, because with at least our first acquisition, we experienced that J curve um, tremendously. It was we didn't know about it when we first bought it, so it was a little of a fun little ride the first 6 months of like, hey, why aren't we matching up here? Now we're back up and grown year over year. Still not a fun few months. All right. Does anyone else have any other questions or yeah, um,
I do not. This was great, though. Thank you.
perfect. Yeah. Well,
Great presentation.
and I appreciate everyone for showing up who could make it tonight and showing up. And I appreciate you, Tim and Cameron, for the time taking time out of your day to give this presentation. It was insightful, and I think it helps a lot of people in our group because 90% of everyone in this group are first-time buyers still dealing with it, and valuation's always the heaviest thing we deal with because there isn't ever a clear guideline for when brokers are how they're valuing it, and it kind of causes more confusion. And this isn't like a house. We can't look at the neighboring houses, compare them. It's unlike you guys, we don't have all that public information or private information to get the data we need. So hearing how you guys approach it and that you're working with these banks, I think provides a lot of insight and comfort to a lot of people to make sure we're not gonna, and obviously you can't always guard from everything. Some people might be paying a little bit much. And
Yeah, thanks for having us. Yeah, I've had my head down doing valuations, so it's nice to get a different perspective and see what kinds of questions people have. So
no, and I think
Just last one more thing. Are you guys looking to ever make this product available to the public or outside of like SBA lenders? Are you thinking that, Tim or Cameron?
yeah, so we do valuations for anyone who wants one. I mean, most of it is banks, but we have business owners come directly to us or brokers as well. So yeah, we could do a bit valuation on anyone who wants
I
a
see.
business valued.
interesting.
Yeah,
No, and
great service because I think y'all too have probably likely experienced it's the wild wild west when it comes to
yeah. And I think people are getting,
this.
Will's got it said it perfectly. It's becoming the Wild West, especially with the PEs in it now. I'm seeing multiples of 6 times, 7 times SDE.
Mhm.
And Will has experienced this with me. It's weird to talk to a broker and be like, this business is doing 200,000 in SDE with no IP, no patents, no real estate, and they're trying to sell it for 2 million. And I'm like, where's this number coming from? It's the worst deal I'll never forget, and it taught me a lot. It was a home service franchise, healthcare, could have put 50% down, and it still would have been losing $20,000 a month.
Yep.
And it's interesting to just hear from a real expert of the value of really evaluating small businesses.
Yeah. Putting a stake in the ground. I really appreciate what y'all doing. Literally putting a stake in the ground instead of just some of these brokers that, and then they get with the seller before anybody else can, and then now these expectations, and now it's hard to reel them back, and now all this disappointment is out there. So I commend what y'all are doing.
Mhm.
Please continue and setting a standard, because I'm pretty sure it's heartbroken. It's heart-wrenching for somebody to get to them afterwards and setting some kind of standard, and they either got to accept it or go to the bitter end, and who knows what happens to their business after that. So just keep doing what you're doing. Yeah, don't stop.
Yeah.
Yeah, our pleasure. Our pleasure. Appreciate that. Yeah, like obviously the SBA loans have the requirement that you got to get the business valuation done, but
Mhm.
even if you're not going that route, like buying a business is a pretty big decision, so it could be worth just getting an independent valuation done, just
Amen.
to feel safe about it.
And I do recommend everyone follow Tim. I need to follow you on LinkedIn. I've been only following Cameron. I do recommend following them both on LinkedIn. They do provide great insight on their post, and it's good to keep up to date with how valuations are looking in this space, because it's always subject to change, especially if interest rates drop in the coming years, probably. And Cameron, if it's all right with y'all, I can put a link to both of y'all's LinkedIn.
Yeah, please.
Sounds good.
Yeah, definitely. The content's been a little bit slower this month since everyone's rushing to get the SBA loans closed before June 1st, but yeah, should pick up again next month.
I always live by one philosophy: take care of yourself first. People will survive a day or two without more posts. Or yeah. But that's our time for today. Um everyone keep an eye out for the emails. I'll post a recording to this to our group. And then if I'll send them the link in the emails. Tim and Cameron, thank you again. And yeah, everyone enjoy your rest of your week. Get some rest this weekend. And please share any updates as you continue on with any wins or losses so we can update the group as a whole. But yeah.
Sounds
Thank
good.
you,
Thank you. Nice to meet
Jackson.
you.
Thank you, Tim.
Thank
Thank
you,
you,
everybody.
Cam. Nice to see everyone. Take
Yeah.
care.
Take
Great
care.
seeing everyone
Thank
again.
you, everyone.
Thanks, everyone.